Hey guys, RC Peck here with Fearless Wealth, and I want to talk about the bank sector. I am tired of hearing people say, "Well, if the banking sector's not good, then the economy's not good, then the market's not good, and you got to have the banking sector participate. And if the banking sector's not participating, then the market's going to crash, blah, blah, blah." You say the same thing. I hear the same thing with the financial sector. The financial sector's got to perform. And if the financial sector's not performing, how can the stock market perform? And the thing is, this feels like very 1990s or fighting the last war or studying for the wrong test. And so, what I want to do is I want to look at specifically the banking sector because I'm hearing this more and more. And I'll actually start with this tweet here. And the tweet here says, "Is it healthy that the BKX relative to the SPY has broken its March 2009 bottom?" So the BKX, there's many ways to, or there's many indices or indexes to track the banking index, and the KBW Bank Index is just one. So let's look at this, because if you hear this and you think, "Oh my gosh, of course, banking, financials, the financials need to be good," but I disagree, and I want to show you why I disagree. So here's KBE. It's a tracking symbol. And on the top of the chart is KBE. On the bottom of the chart is IVV. And actually, let me just make IVV, just make it a little bit bigger here. So this right here, let's just look at this part up here, the top part of the price chart. If you look at that, that looks like sideways to me, right? It looks like whether it's a company or a sector or a subsector or an industry, it's gone sideways during this, basically between these two blue lines, that the price is basically sideways. Now, if you just take this, and I'm going to zoom out, but if you just take this 1 3-year period and you say, okay, the banking sector, I mean, we can actually look, the banking sector went up 11%. If you then compare that to the S&P 500 with dividends reinvested, the S&P was up 57%, right? So here's an example where the banking sector did nothing, went up 11%, while the S&P went up 57%. And I can exchange the word nothing for 11% and say banking went up 11% and the S&P went up 57%. Now you might say, well, RCC, it went up 11, the S&P went up 57. But I think what's better is if we just divide the banking sector by the S&P 500. And if the line is falling, that means the banking sector is underperforming the S&P 500 with dividends reinvested. And if I zoom out to 10 years, you can see that the banking sector and we'll zoom out farther, but the banking sector from 2010 just until today, the last decade, the banking sector has been underperforming. And this makes sense. Like, I don't know why you walk into a bank anymore. Like, I barely use checks anymore. Like, everything is done wirelessly, online, Venmo, PayPal. Like, when I walk into a bank, it's because something went wrong. Right? You can even open and close accounts online. And so the banking sector is being left behind because they have not embraced technology. They have way, way too many middle managers making $200,000-$300,000 a year that aren't needed. And this is what this relative price chart is showing. It's showing that the banking sector, it's shrinking in size because it's becoming less relevant. You don't need to go into banks anymore. I mean, how many of you carry quarters and nickels and dimes or whatever your equivalent would be in your own currency? Change, right? Metal currency. You just don't do it. I can't remember the last time I had change in my pocket. And the only time I keep cash is literally I have 5, 10s, and 20s to either give away to homeless people or people living on the street, or to tip, because I've recently learned that if you're going to tip someone, the 5, 10, and 20s in cash is actually the best way to tip and not on your credit card. But I believe the banking sector has been irrelevant for a decade. And here you have the banking sector falling over this 10-year period relative to the S&P. And during this time period, the S&P has gone up 230%. So I'm going to zoom back. Let's go back 15 years. so we can get the big fall in. But here's the banking sector. The banking sector was losing its relevance even before the global financial crisis. It was falling. And that's the last 15 years. Let's go back 20 years to the turn of the century. So KBE is a tracking symbol. So this tracking symbol specifically only goes back to 2006. But you can see even from 2006, call it 15 years, it's becoming more and more irrelevant. And I've talked about this before with energy, that energy used to be 30% of the S&P in 1980, and now it's 3% today. The same thing is happening with financials. They're just becoming more and more irrelevant, right? Because you use PayPal, you use Venmo, you're using technology. We are using technology to run our lives, and we're not walking into banks. And so I don't actually think the banking sector needs to turn around, or I don't think there's any reversion to a mean. To me, this is the sign of the times going back 2 decades, which is not a fad. That's a trend, guys. And I bring this up because people like it, the market can't go higher if banking can't get back on its feet. And we could do the same thing with XLV. And you've seen me do this before with XLV, where, sorry, I'm saying XLV. In my brain, I'm thinking XLF, not healthcare. Um, but if you look at the whole financial sector itself, and you think about what makes up these companies, right? What's in there? There's banking stocks in there. Okay, they're becoming more irrelevant. There's brokerage companies. They barely charge for anything anymore. Everything is free. And then you have insurance companies. But as you look at this, and again, the top price charts. So I want to be clear what you're looking at. This is the bank. This is the financial sector just being divided by the S&P 500. And guys, it never got up off the floor after the global financial crisis, even though the Fed bailed them out. I mean, look at this right there. This is a relative price chart, but it can never break above. That's a huge, huge resistance. And down here, it used to be that this relative price chart couldn't break below this support, but it's not a support anymore. And look at this. It's broken below its global financial crisis low, right? Financials are going to continue to get weaker because they've never adapted, right? Probably half of their middle management needs to be fired, and they need to really, really embrace technology. And the ones that are, right, because PayPal is a financial company, so is Venmo. I don't know who owns Venmo, but it's the same thing as PayPal. And you can just see these sectors and these parts of these industries that they're not going to disappear. They're just going to become a shadow of what they were before. Now, I bring this up because we are sold narratives, we are sold stories, we are sold, what if banking doesn't, get back up on its feet, how can the market possibly go higher? And you hear this and it makes sense, right? But then when you start actually looking at the price charts, things change. So one of the big takeaways is you've got to learn to think with your eyes. You've got to be trained to look at price charts. So thanks so much, guys. This is just another step in really helping you bring that control and that clarity really back into your life. And look, if you like this stuff, you're going to love my X-ray. I have this portfolio X-ray. It's super easy to get to. You can just go to fearlesswealth.com, X-ray/X-ray, or you can just go to the top of the comments and there's a link. Basically, we look at your symbols and I show you which ones are helping you and which ones are hurting you. Thanks, guys, for being in my world, and I will talk to you